Welcome everyone. I'm here today with Sal Caruso, the founder and CEO of Quantum Advisory Group, a wealth management and investment advisory firm. Welcome. Thank you for taking the time to do this today.
Hi, Vincent. Thank you. Thank you for this. First, I would like to thank you for giving me this great opportunity to educate you and your friends on financial planning, investment advisory. One of the greatest things about my job is I love educating people, helping them, educating them on managing their money, managing their finances, investing, different ways of investing. It's a passion of mine, and it's always been a passion, no exaggeration, since I'm about 15 years old when my eyes lit up when I was first introduced to Wall Street. I went to aviation high school, and I left aviation high school to start my career on Wall Street. And that's how passionate I am about this. But nothing's more gratifying than being able to share my knowledge and help people. So thank you.
Thank you.
Before we begin our interview, I'd like to, it's very important that I say a couple of words on the things that I'm going to be discussing, in the sense that I'm going to be speaking generally about investing, about information, what's going on, in the markets, whatever questions you have for me. But I strongly suggest that none of your viewers act on my information. What my answers to your questions will be based on my experiences with my clients, and are specific to my clients, obviously without divulging their names or confidential information. But no one should act on this information, because a financial planner only makes recommendations based on interviews with the client and on their personal situation and their circumstances. Financial planning involves getting to know our client very, very well. In some cases, very personally, we ask a lot of personal questions like, how much money are you making? What are your expenses? Where's your money coming from? What are your goals? What are your dreams? What are you planning to do? People share a lot of information, and that helps people like me to make financial decisions and financial recommendations based on that person's circumstance. So you can take this, and you'll be educated on it. But before anyone acts, I would strongly suggest that they speak to their own financial advisor, or by all means, I'd be more than happy to answer any questions your viewers have. So I'd like to start off with that, and thank you.
Right, understood. Thank you. So I think people would be fascinated to hear a little bit about yourself and maybe how you got to where you are, and some of the jobs and titles you've held.
Sure. I guess my resume is not that many. I don't have that many companies on my resume, because, as I said, at the age of 15 is when I really fell in love with Wall Street. I worked for a bank, a local savings bank in Brooklyn, New York, in my college years. And to give you an idea of how I've always been passionate about finance and banking, I was literally appointed as branch manager at the age of 23 years old. And I was given the third largest branch of the bank.
Wow.
The bank no longer exists. It's been swallowed up. It's now known as Capital One. But when I was there, it was just a small community savings bank with 18 branches. And from there is where I realized many people always came up to me and asked me so many questions about different financial issues other than banking. And I realized quickly I enjoyed doing that and helping people. So for about 30 years, my financial background is, I started my own company in 1996. I was about 26 years old then. I started my own financial planning and investment advisory company. I then started a brokerage company, which grew substantially, which was basis of my career, the focal point of my career over the last 20 years. I no longer have that company. So throughout my career, I started off as a certified financial planner, CFP, registered investment advisor. I owned a brokerage company. I've obtained many securities licenses, like the FINRA Series 7, Series 24, which is a manager's license, a 27, which is a financial and operations principal license, the 53 municipal securities licenses. I've had so many licenses. I also have my accident, health, and life insurance licenses. I still have those presently. I no longer have the securities licenses because I'm not affiliated with the brokerage firm. So I've held positions as chief financial officer, chief compliance officer, operations officer. I've been through the gamut, but my passion has always been what I'm focusing back to now. I call it going back to my roots, which is being a certified financial planner and a registered investment advisor, which is totally different than owning a brokerage firm and operating as a stockbroker or a registered representative. It is a completely different business model, same industry, but different business model. And I am not a stockbroker. So it's important for your viewers to understand that. Okay.
So you said you used to work at a small bank, and these days, we don't really see any small banks. The big ones have really just swallowed them all up, I guess, huh?
Yes, that's pretty much it. In fact, most of your local banks that may still exist are now owned by larger banks that own them and are subsidiaries, and they just kept the name of the old bank,
right,
to appease, the clients and make them still feel like they're still with their old bank. But yes, small banks are rare, very rare these days.
Right. So I guess next we could just move into, the general state of the market right now. I wonder what your thoughts are on, a lot of people say, we're in a bubble right now. This is just like the .com bubble and burst. What do you think? Do you think we're in a bubble, or is it similar, or is this something totally different?
Honestly, I don't believe we are in a bubble. The market is a little bit ahead of itself, in my opinion. Mm-hmm. But when you say bubble, that's an extreme upside. Right. .com era, the .com stocks and at one time the biotech stocks, biotechnology, the farmers were in a bubble, because the famous words of former Federal Reserve Chairman Greenspan, irrational exuberance. And that was a perfect expression, especially in the .com era and bubble. I don't believe we're in a bubble today. I don't believe we have irrational exuberance today. We do have some sectors which are overly valued a little bit, and mainly that's technology. And my belief is that's the technology sector that is a little bit ahead of itself. One of the best things to look at to see if, not so much as if we're in a bubble, whether we are overvalued, is something called a price to earnings ratio, or PE ratio, as we call it in the industry. And what that means is price to earnings, which means how much is an investor willing to pay for every $1 of earnings that the company produces, okay, of net earnings. So for example, if a company has a PE ratio of 25, it means that you as an investor are willing to pay $25 for every $1 in annual earnings.
Right.
Okay. Today, the PE ratio, I'm not too sure what it is in the market right now. I believe it's approximately 28. But one way of investing also in different sectors is, you can look it up easily on any good financial publication online, Well, they'll say, okay, so you look at Apple stock, for example, and it has a PE ratio of 35.
That's the one I was thinking of. Yeah.
Yeah, and yet, you'll see with some of the with some of these financial publications that the PE, it'll say at the industry PE ratio happens to be, I'm trying to look it up as we speak, if it tells this to me here. Okay, so Apple's PE ratio is just about 35, and it'll say the industry average is about 28. Right. So Apple is overvalued in that respect. Okay, right. So people are willing to pay $35 per share for every $1, $35 for every $1 of earnings. Mm-hmm. That's a good metric. How much are you willing to pay? Now, years ago, the PE ratio for the entire market was 15, 12. But what happens is over time, people get adjusted to paying higher PE ratios. They get adjusted to seeing higher PE ratios. 35 is a little bit high. Apple's PE ratio at one time was only about 12, and that was only about 4 years ago. Mm-hmm. And again, this is just an example. So the answer to your question, no, I don't believe we're in a bubble right now. You have to be selective and watch, what you like, and just do simple review and analysis.
Right. Yeah. And getting back to about the .com, .com bubble burst. Obviously, I lived through it. I wasn't investing at that point, but yeah. Just from everything I've read, it seems like, I would agree with you that I think that was something totally different, irrational exuberance, where everything was based on hype and future growth and earnings. Yeah. Whereas now with, Apple, Amazon, Microsoft, these companies have, they might be a little overvalued and they're heavily weighted, but they kind of are putting up the numbers to show it. Like I don't think
exactly
as far.
Again, it's all based on what people perceive to be their future performance, their future revenues, and that's why they're willing to pay so much for every earnings. They're gambling on future growth.
Right.
Yeah.
And especially with tech being overvalued, but like it's overvalued, but ever since the pandemic started, I mean, these are the only companies that consistently have continued to thrive or even done better in some cases, whereas everyone else is struggling.
Well, there's a reason for that, but we'll get to that later. But there's a reason why tech stocks, and I'll tell you what it is.
Okay. So I guess kind of relating to that, how would you navigate, the current market and, investing in a crisis, and what, if anything, do you think has changed, and where do we go from here?
Well, the way you navigate the market in general is you always have to look at what's going on at that moment in time. And moment in time doesn't necessarily mean today. It could mean the moment in time of in the month, in the year, what's going on in the world, okay? Markets move on information or lack of information, uncertainty. When there's uncertainty in the markets, generally the markets will go down because they have no direction. They're reverse, the market is, we don't know what's going to happen. For example, and this is, please, by no means political, when President Trump was diagnosed with COVID, what happened to the markets? They went down. Yeah. They gained, they cut their losses, but they were huge jitters that if he died, it would cause economic upheaval and turmoil in the world, and not economic upheaval in the world, but it would cause problems. It would be a negative effect on the markets. So the market starts selling off. When he was diagnosed, when he was, everything's okay and information starts coming out, the markets stabilized and moved back up. The stimulus, they announced that the stimulus package, they're not going to pass it. And the markets went down on Monday. On Tuesday, the market went up for another reason. So you navigate the markets. The one constant about the market it will always move up or down, and the volatility can be, uh, really huge, or it can be just normal market volatility. And it
Right.
all depends on the current situation, what's happening at that moment in time. Um, there's always opportunities for making money in the market, whether the market is going down or it's going up.
Mm.
You know, the bulls and the bears. Here's a nice saying that you may or may not be familiar with on Wall Street. Bulls make money, bears make money, pigs get slaughtered.
Yep.
Okay? And greed are the pigs, right? That's, but it's an old Wall Street saying, and it's been around forever.
Mm.
But when the market is going down, people that are selling short the market, and I'm not sure if you're familiar with what that means, is they're selling stock that they don't own. They're borrowing.
Right.
Okay, and then they have to replace the stock. So they sell the stock at $100 a share, hoping that it goes down to 50, and then buy it back at 50 and replace it. They pay interest on borrowing that stock. They pay a cost for borrowing that stock, but at the same time, they sold it at 100. They bought it back at 50. So that's what happens and there are rules and regulations for when you can sell short. That's just an example of how people make money when the market's going down. But what has changed with the markets? The only thing that ever changes is world and economic events. That's the only thing. But the constant in the market is how it reacts to all these different economic and world events. Like now we're going through COVID. We went through the financial crisis of 2008, 2009, World War II, the Korean War. All these major things that happen around the world are what makes the market move. So what's different? Nothing. It's the only major difference is the speed of information. In let's say 1900, okay, the year 1900. The only way to get information at that point was, I think we had the trains, if not by Pony Express. So some person knew information about an economic policy that was going to, the president was going to raise taxes and it was going to hurt the economy. And who knew at that point? Just a handful of people.
Right.
How fast did it travel from Washington, D.C. to, all across the United States? It took forever. Okay. And the markets, whatever the market was back then, reacted to the information as it received it. Today, you sneeze and the world knows instantaneously.
Right.
So that is really the major difference in the markets. Yeah. It's the speed of information. And that leads to something called the efficient markets theory, something I learned in college. I don't even know if they teach it in college these days anymore. If you're taking finance courses. But the efficient markets theory is basically the world, the investing public, has a piece of information all at the same time. Everyone has the same information all at the same time.
Right.
So everyone reacts swiftly to that piece of information. There is no a group of insiders that know the information and then 3 days later someone else knows it. Right. So technology is what has caused the markets to react the way they do, because now, again, some information comes out, everyone knows it simultaneously, and that's where you see the insane volatility at times.
Yeah.
It spikes up or down.
It's all right here, and then we get lots of impulsivity,
Okay.
And I'm guilty of it too. You make irrational decisions.
Exactly. So that's what's changed. Again, don't look at any specific event as being any different than any other event. It's different where we have this pandemic, right? But we've had pandemics before. 2009, Swan. But again, every month or every day, there's something new that comes out, and all it does, when you look at it from an investor point of view, is it a negative impact or is it a positive impact to the markets, and how are you going to react to it?
Right.
So it doesn't matter what happens. Something's going to happen. The markets are going to react. How are you going to react?
Mm-hmm.
That's it.
So getting back to what you said about the efficient market hypothesis, I know, there's the camp that says today that, due to that, like value investing and Warren Buffett's whole approach, and Ben Graham and all those guys, they say value investing is dead because the whole way that they invested was, they were finding things that everyone didn't know, like undervalued assets and things of that nature. So do you think that, what's your stance on value investing? Can you still, find value in that regard, or is it just more so, all based on future things that people aren't considering?
Well, one of the key advantages. Well, first of all, yes, I do believe that there is value investing still exists,
Mm-hmm.
and we'll go through a couple of examples probably in your next section. But value investing still exists. But the key benefits of someone like a Warren Buffett, or an investment professional that works for an analyst that works for Goldman Sachs or one of those companies is, they get to go and speak to the CEOs of those companies firsthand.
Mm-hmm.
They get access to a lot of other information firsthand. Now, the general public has access to that. A lot of especially today, when a company, like IBM reports its earnings, they provide an earnings report, and on the news you'll just see headlines, right? But
Mm-hmm.
you go on IBM's website,
It's all there.
there'll be a link to the detailed earnings for IBM. Okay. From there is where a person like Ben Graham and Warren Buffett have their computers. Today it's computerized. Back then it was by hand,
Mm-hmm.
where they looked at the company's performance and determined this company. They did a huge analysis on the company and said, you know what, we believe based on our analysis that this company is really worth $100 a share. It's currently trading at $50 a share. It's undervalued. We're going to buy it.
Right.
Well, the reverse. We believe it's worth 100. It's trading at 150. We're not touching it. We don't think it's worth $150 a share. There's a lot of metrics that are publicly available today. When you pull up a quote on, I don't know, Yahoo Finance or whatever financial online thing you're looking at, where you'll see different ratios. There's something called a price to book ratio. What's the book value of the company? So if you took the company apart and sold it off in pieces, how much are you going to get for the company? That's the book value. Okay. I mentioned price to earnings. There's other key ratios and indicators that are easily available that people can say, well, you know what? I don't, for me, I don't, they don't have to be financial geniuses. They can, compare the company to the industry. They compare the company to another competitor and see, okay, what's the true value of this company? And there are a lot of ratios out there that give you a good indicator. So you can make your own decision and say, all right, I'm willing to pay a little extra, even though I know it's overvalued.
Right.
I'm willing to pay a little extra. No, this company is way overvalued. I'm not going to touch it. And just so for your viewers, a stock that's trading at a penny a share can be highly overvalued. Just, people should not make the mistake of thinking that if a stock like Google is trading at 2,000 and change a share, and a stock that's trading at a penny a share, that stock at a penny a share can be 100 times more overvalued than Google.
Right.
Because that penny a share stock, could have absolutely zero earnings, could have absolutely zero cash. You're paying a penny a share for it. For what? You might as well take a penny and play kickball with it or something.
Right. And I think that's a problem. It all relates, to the how all the information is instantly accessible, and like you said, but people don't realize that, and they see Google, a great company, at let's say 2,000 a share, and they say, oh, I'm not going to buy that. but then, they'll put $10,000 into a penny stock, and
Right.
whether you have 5 shares of Google or 10,000, penny shares of a penny stock, and it goes bankrupt or it goes to zero, you still end up with $0.
That's right. That's right. So,
You brought up IBM before. I just did a video on them earlier. What do you think of the decision to spin off the company?
um, I I think it's good for investors.
Mm,
It unlocks value because in a spinoff of a company as sizable as IBM,
mm,
I mean AT&T is probably the best example. People that owned AT&T since the 60s probably didn't make too much money. The 70s, I don't remember. The 70s uh, probably didn't make too much money on the actual share price of AT&T, but
right.
they made
I
a
think
killing on all of the other companies that AT&T spun off. So if you owned AT&T, at one point, if you own the original AT&T shares, at one, and it spun off all of the other phone companies, which today are called Verizon and
right.
Singular and AT&T Wireless and Lucent Technologies and all. You received, as an AT&T shareholder, you received shares of each one of those companies that on their own either performed very well or didn't perform as well.
Mhm.
But so for the most part, when a company like IBM spins off a division or a unit or a wholly owned subsidiary, it's usually a good thing. It unlocks value for the company. It's another way of streamlining the company's uh, assets and streamlining the company's operating costs and units so they could focus and concentrate on what their goals are and
Right.
let that unit run on its own,
Mhm.
okay, and let it be its own self-sustaining company. So it's generally a good thing.
Yeah. Yeah. IBM, I own a small position, and, I'd been considering getting rid of it up until the announcement came. And then I was like, all right, I'll look into this. And, after I did the research, I feel good about it too. I think
Right,
new CEO,
right,
Arvind Krishna, I think, the future, it's definitely an underdog story. I mean, they're way
right,
behind still the likes of,
right.
Amazon, Google,
Sure,
Microsoft,
sure,
etc. But I like the underdog story, so I think I'm going to hang on to them.
sure.
Um,
Good.
with with AT&T, yeah, I know I have family and friends who have owned AT&T forever, and then they
Right.
got Comcast spun off out of it, and that went on to do very well.
Yes.
Um,
Um,
so regarding, I guess we kind of touched on this for asset allocation. Uh, are any sectors more appealing to you now than others? And you know, in the short, medium term, or long term, like what do you think? Should investors be staying away from any industries?
Okay. Well, let's first. I want to clarify something with you. You're talking about asset allocation versus sector allocation. So, an asset class, for example, stocks is an asset class. Real estate is another asset class. Um, um, Insurance is another asset class. Okay, so when we talk about asset allocation, and then you have, you know, and then you have the um, uh, large company stock, small company stock. That's again asset allocation. Okay, sector allocation, which is what I think you're kind of asking about, because in your question you're saying, what sectors or uh, what industries. Okay, that's more of a sector allocation. So I want to make sure we define that clearly. So as far as different investment sectors right now, I kind of I'm focusing on many different ones, and I like quite a bit of them. So financials, I like some of the financials, not insurance, mostly some banks. I like some banks. Airlines, I like airlines, and travel, cruise, consumer goods and technology is what I'm focusing on. right now. And like you said before, you like the underdog. Well, so do I. How much risk are you willing to take? Okay. So I looked at, these industries that got hammered by this disastrous disease and pandemic.
Mm.
And then I look at individual companies and I say, yes, we're going through a very rough time. And I start thinking not only about the company, about the company's performance, its balance sheet. How long is it going to be able to sustain operational business without any revenue? Okay, what's management been doing? Then I look at what is the government doing to support these industries, and I say to myself, I don't think that the U.S. government is going to allow the airline industry to collapse.
Right.
I don't think that the U.S. government is going to allow the banking industry to collapse.
Mm-hmm.
How's the banking industry at risk? I hope people realize this. If you have 30 million people out of work and they have credit card payments and loans, where do you think the people are going to spend their money first?
Right.
They're going to look to put the food on the table. That credit card payment is getting pushed aside.
Mm-hmm.
That's how banks and financials are going to get impacted.
Mm-hmm.
So I like them because I'm looking at good, solid companies, strong companies, and I'm willing to take a risk on these, especially at the prices that they went. Some of them went down so low, and some of them are back to being, at March prices, when in March 19th or 20th was like the low point in the market before the rebound started. Some of those stocks, some of the airline stocks are back down to those levels. Some of the oil stocks are back down to those levels. So I looked at it as, before we said value investing, I believe that there still is value in a lot of sectors, especially the airlines, the cruise line, and the travel industry. But there's a huge risk.
Right.
If the risk is how long, if the country stays locked down, and not just the United States, but other major European countries, other Australia, the longer a country stays shut down, not only is it impacting their own country's economy, but it's impacting world economies, because there's no trade, there's no travel, there's no tourism, everyone gets affected. So how long are we going to stay shut down? And you watch and you follow and you make a judgment call. I made my judgment calls, and these are the sectors that I like. As far as the asset classes, I pretty much stay with large cap stocks, with large company stocks, and not for any particular reason. These are just the ones that attracted me the most at this moment in time, because I like all asset classes, small cap stocks, medium, mid-sized companies, and there's so many investment products. I still look at real estate. Not that I do much in real estate, but I follow real estate to see what the trend is, because real estate activity is also a good indicator of economic performance. Right. The more housing sales there are, the more people are going to buy furniture and paint and fixing up. And so things like that. And even insurance products, things called tax-deferred annuities are one of my favorite asset class, one of my favorite investments. I like them better than bonds. Mm-hmm. There's things out there called equity indexed annuities. They're insurance products. And in plain, simple layman's term, they are a bank CD with an insurance company, and they pay you interest based on the performance of either a stock market index or a private index, like the Schiller index or Barclays Trailblazer index. Mm-hmm. But there's a lot of information that needs to be discussed about that. But it's another great tool that I use, especially for retirement money, because it's a long-term investment. Right. So though, as far as the asset classes, again, it all depends on what's going on in the economy at any given moment in time.
Mhm.
And you take a look at them, and uh, the most important thing I want to stress is you determine an asset class, you determine a portfolio after you have a detailed conversation and analysis about that specific person's financial situation and personal situation, their risk tolerance, their goals, their dreams, their savings, their earnings. What are they doing? All of this. And that's when you take all asset classes into consideration. A good financial planner is going to look at that individual's detailed life, okay, financial life, analyze their preferences, their risk, their this, everything about them, and look at all available investments out there based on that and say, okay, based on everything we discussed, I am recommending this portfolio. That includes individual stock, that includes bonds, that includes an insurance company's annuity, that includes real estate. And I suggest we use these asset classes and we invest in these different sectors. And this is the projection. And we can draw income at a certain point, all of these things. So you take a look at all available asset classes, investments, and you create something specific for that person.
Right.
Okay.
So next couple of questions I had, I think we kind of touched on already. But how do you think the markets will be impacted by the upcoming election? Or I know it's, you don't want to get into predicting and stuff, but I guess maybe depending on who wins, would you change anything? Do you think certain either, industries or asset allocations will fare one way or another?
Yes, it has to do with whoever wins the election, what their policies are, and how their policies are going to impact the economy and different segments of the economy. We have one presidential candidate that is very big on climate change and that aspect, and he wants to invest trillions into renewable energy. Well, okay, we have to take, if he wins, if that candidate wins, and we would have to take a look at renewable energy companies and companies related to climate change and see, what they're doing. We might have to shift from this sector to that sector. Okay, so it all depends on, we might have to restructure an entire portfolio. Okay, and it all depends on the president's, the winner, what their policies are. Okay, and that's all we care about. We don't care about political beliefs or political, I like him, I hate him, I think. Who cares? When you're an investor, you really don't care. Right. All you care about is, what is this guy going to do? And how is it going to impact my investment portfolio and my performance? And I'm going to make adjustments based on his beliefs and his policies. And the market, again, it's just another circumstance where the market reacts to that information. But interestingly enough, the markets have tended to predict the election results, okay, for, for the last 100 years, where the market, depending on the market movement, the market actually can predict, or it has predicted in the past, who will be the new president. Okay, and there's a great article, and I'll email it to you, and you can post it if you'd like, from one of the investment companies, one of my favorite investment companies, and I'll send it to you, and you can do with it what you will. But it's interesting that the market actually predicts. I don't know, they also write a disclaimer. They don't know, this year's a special situation. Right. We don't know.
Nothing is guaranteed, right? Yeah. I think I've seen that as well. It's interesting.
Yep.
So what about, trade policies? And we kind of had the trade war a while back, and we touched on, if the pandemic continues, but if these issues resurface, how do you think the market will react?
If the pandemic continues, the market will react negatively. Again, but so let's talk about, before I mentioned how technology, okay, one of the reasons it's overvalued, I believe, is overvalued, and one of the reasons it'll continue, I believe it'll continue with an upward movement. So and again, information and analysis, right? One of the reasons technology stocks took off the way they did is because we literally kind of created a new, I don't know, for lack of a better word, industry, where now people are working from home, right? So what happened? Well, companies like Microsoft and JP Morgan and GE and you name it, all the giant companies of the world, and even smaller everyone working from home, they needed to invest in new technology. So now people needed to buy new MacBooks. People needed to buy new software. People needed to they needed to upgrade their network, okay, their internet speeds. People needed to buy more antivirus software. People, it went up the chain. Every aspect of technology was needed for people to work at home. And then you have today Microsoft announced that they're going to ask the majority of their employees to work from home permanently.
Right. Wow.
What's that do? Again, more technology spending, more resources needed to adapt to this new whatever you want to call it. And so the investor perception is technology stocks are going to keep going up and up and up because people are going to need to spend more on technology and they're going to make a lot of money. Okay. So if the pandemic continues, now trade policies in a trade war, completely separate from what I just discussed. Trade policies in trade war, I believe that we need fair trade. And I believe that NAFTA was a disaster. One of the things that I've seen that I've seen in history, even in my short life, is how the United States creates these deals that benefit the other countries more than they benefit the United States. Case in point, all these medicines that we needed to help fight COVID are being mass produced in China.
Right.
All of them. Did you know that your Tylenols and basic aspirin is produced in China? Okay. That means this country lost more jobs and gave up more jobs in just about every trade deal, okay, where the other countries benefited more than the United States. I don't think that's fair. I don't think that's right. Other countries imposed huge tariffs on their imports from the United States, and the United States has very little tariffs on their imports here. So this is what happens, and you saw this firsthand. This past November, December of last year, where huge tariffs were being threatened and imposed on imports from China. The market reacted negatively at first because who was going to pay for these huge tariffs? Me and you, the consumer. Right? It was starting a trade war. But look what happened in the end. In the end, both countries negotiated what seems to be a fair deal. The United States increased its tariffs to a reasonable level, okay? And both countries met in the middle, and here we are today with a good trade deal.
Right.
Okay? So yes, how that absolutely impacts the economy, because higher tariffs to another country means less imports. Right. If the other country increases their tariffs on our imports, less production in the United States. So it hurts each country, okay? It does hurt each country. But when you come to a fair trade deal where both countries benefit, where citizens of both countries benefit, then yes, it's a good thing.
Mm-hmm.
Right? And I believe in today's day and age that more leaders are apt to make a good, because they know it's not worth the pain to their people in their country. So that's what I believe about trade wars and trade policies. If there is a trade war, it's a negative impact, as you saw initially with China and the United States, but then everything leveled off and the market just exploded from there.
Right.
It was another cause. It was another reason for the market to go higher.
Mm-hmm. Yeah, and it's definitely, it's tempting to, these things happen, and you try to start like predicting the market, and I'm definitely guilty of it too. And
yeah,
there's just no way of knowing. I think Warren Buffett said it, that their investing philosophy is that they buy great companies because they're great companies. They don't
right.
base it upon economic predictions. And I'm just thinking, I'm like, that's definitely a philosophy I think that would help a lot of people. It'll definitely help me, because
Yes.
every impulsive decision I've made based on, I think this is going to happen and it's going to affect this, it never pans out that way. And, you're always better off, or for me, I found at least, I would have been better off holding or not basing my decision on that. So definitely interesting. So I guess to pivot a little here, what would be your advice to someone who's just starting out investing?
Okay. I wish I could remember his name. A great portfolio manager, money manager for Fidelity Investments.
Peter Lynch?
Who?
Peter Lynch, was it?
Peter Lynch. Peter Lynch. What was Peter Lynch's famous saying? He always said, invest in what you know. Okay. That's the first thing. So, my daughter, Victoria, jokes around all the time about, about the sneakers, the brand of sneakers I wear. And I won't mention it. She'll say, Daddy, they're old man shoes. Why don't you buy Nikes? I'm like, I don't like Nike. Okay. My other daughter, Christina, would say, Daddy, those jeans are old. And I'm like, I like my jeans. That's not what people are wearing today. I don't care.
Right.
The point is, Victoria likes Nike, Christina likes, I don't know, whatever else. Okay. Well, they know their product, right? Okay. So if you like a product so much, why don't you start looking at how much is it selling? How much of that product is selling? What's the population that's buying it? What are they, how many people are using their product? And you start getting to know your company. That's a good basic starting point. But after that, you need to educate yourself a little bit on the basics of the markets and investing and the stock market. Okay. You need to have a basic fundamental knowledge. What makes the markets move? Okay, I discussed briefly what it is. It's information, good or bad, and how, or lack of information. Okay, and that determines what is impacting, how it's going to impact the markets and what makes the markets move. It's always information that makes the markets move. And we drill down to a specific company. Okay. Here's how the markets actually work, using the example of a specific, and I won't name the company, XYZ company. Okay? The stock market is called an auction market. There are people who are willing to buy and people that are willing to sell a stock of any company. What creates the stock price to go higher is that there are more people willing to buy than there are sellers. Supply and demand.
Right.
So we call it an auction market. The example is you have a famous painting, Picasso. There's only one painting of its kind. There are 50 people in a room. They all want that painting really bad. Okay. And they all start saying that you have the auctioneer, the auction guy saying, oh, You know, who'll give me 100? Who'll give me 100? Who'll give me 200? I'll give you 200. I'll give you 500. They keep bidding the price up. There's only one painting, 50 people want it. Eventually, one person is going to have more money to pay or willing to pay, not necessarily more money than anyone else, but one person is going to be willing to pay a final price. Same thing with the stock. Now, first give you the example of there are 1,000 Picasso paintings, same painting, but only 50 people in the room willing to buy it. The guy that owns 1,000 Picassos, he's willing to sell them. And he wants to get a fair price. He wants to sell them for $100 each. And but people are looking, I'm not going to pay $100 for that. He might get one or two people that do it. And everyone else walks away. And he says, no, wait, guys, I'm going to discount it. I'm going to put it on sale. I'll give it to you for 80. Maybe a couple more people buy the painting. And everybody else walks, no, I'll bring it down to $50. You get a few more people. But he still has 500 paintings left. And he wants to get rid of it. He's desperate. He needs money.
Right.
He needs money. He's very desperate. He's like, look, I'll give it to you for $25, tells the remaining people. And he sells a few more. You have oversupply. You have too much supply and not enough demand.
Right.
Same exact thing occurs in an individual stock.
Right.
When you have a lot of demand and little supply, that stock is going through the roof. Why? Because the buyers, you have so many people demanding, wanting to buy that stock. Sellers are not selling. So buyers will say, all right, I'll give you 100. No, I'll give you 150. I'll give you 200. That happens instantaneously when you look at a stock quote. You see the stock blinking, right? Those are people, buyers and selling that stock. And who's willing to pay a specific price for it? On the other hand, when the stock is collapsing, it's because you have 1,000 sellers and no buyers.
Right.
And all the sellers are panicking. Get out, get out, get out. I don't care. Just get me out of the price. Supply and demand. What creates supply and demand is the news that hits the company, information. One company can say, we just invented a product that's going to cure all cancers. The entire world is going to want to own that stock. That price is going to go to oblivion. Okay? On the other hand, the company says, we missed the decimal point by 3 decimal places. Instead of earning $1 billion, we lost $1 billion. Mm-hmm. And we have major accounting problems. Everybody's willing to sell. Enron, for example, the scams. Supply and demand. So basically, what do I tell someone? I guess I gave a little bit of a learning lesson who's starting out. Educate yourself on how the markets work. Educate yourself on how investing works. Educate yourself on different investing techniques, something called dollar cost averaging, where you invest the same amount on the same day of the month, and this is usually done through a mutual fund, mm-hmm. where you use something called dividend reinvestment plans, a DRIP program, where you own a stock, and if you like the stock and you want to hold on to it, whenever the company pays a dividend, you reinvest it in the same stock. Right. It's a way of growing your shares without taking money out of your pocket.
Right.
You need to really assess yourself, know what your goals are, you do a little bit of very simple math, very simple common sense. This is how much I'm earning. These are my expenses. This is my own net income. Okay. What am I doing with this net income? I'd like to save to buy a house one day. I'd like to save for my retirement. I want to put some money into a retirement plan. So you do a little self-assessment to yourself. You educate yourself on different ways of investing and on the markets. And then you speak to a financial professional, and you get it not so much with friends, but friends will give you good advice, but they're not the end all. They are just good information.
Beginning.
Go to websites with financial resources. You know, Fidelity Funds is great. My own website, I post a lot of great blogs. I have a newsletter subscription that great financial planning tips and investing. But avail yourself to the unbelievable information that's out there today from good, credible companies. Educate yourself first, and then speak to financial professionals, get some advice, and lay out a game plan.
Right.
And invest for your goals. Invest for retirement, invest for buying a house, buying a car, for whatever reason. The most important thing that I think everyone should do first, the first most important thing is set aside emergency money.
Mm-hmm.
Have an emergency bank account with at least, you know, under normal circumstances, I would have said 6 months, but because of COVID, you want to have 6 to maybe 8 to 10 months worth of money to use to live off of in case you don't have a job.
Right.
Your worst case scenario, you say to yourself, these are my monthly expenses, my mortgage, my insurance, my car payment, my electric bill, my phone bill, my cable bill, food, going out. This is how much I spend every month, $3,000 a month. You want to try and have at least 3 times 6, okay? And have that much money, 6 months, 8 months, in a savings account. That should be everyone's first goal. And at least that's your emergency. Stick it in a regular bank account. You're going to earn 0 interest. Who cares? It's cash. It's instant cash.
Right.
Because if you invest it, your risk is when you need the money in an emergency, your $24,000, okay, or $18,000, whatever it is, your $20,000 that you saved can be worth $12,000 because you invested it and now you need it, and you need it at a time when the market's collapsed. And now what? Okay, so you want it in a regular, safe bank account, doing nothing, and then focus on your dreams, your goals, and invest. And yes, people your age and younger. I've been investing for my daughters since they were born. And I'm happy that I did. They own great companies. And as risky as the markets are, they probably are the greatest investment, the greatest tool for the best returns, even with all the insanity. However, again, today I mentioned there's a lot of other types of investments, and it all, you know, usually for older people or for retirement accounts, that are much safer and can give comparable market returns that are out there. There's a great universe of different types of investments, and it's up to the financial professional, again, analyze, get to know, and say, this is what I think is best for you. And make sure that that person understands everything that you're recommending and what that product is, exactly how it works, the risks, the rewards, and the client makes the ultimate decision.
Right.
Okay. That's pretty much it.
You brought up Peter Lynch before, reminded me.
Oh,
It's a couple summers ago, One Up on Wall Street. I got to give it a reread because I think a lot of those principles still hold true, and now more than ever.
This is a great, fantastic book.
Success. Okay, yeah, I've heard of that.
You see it now. I'm looking for the smaller version.
I have
Remade. The smaller version that was remade, and this book is not so much on investing. It's about the laws of success of life.
Right.
And it's truly an amazing. I bought this for my daughters also.
Yeah,
it's truly an amazing book.
That's not the same as this,
Think
is it?
and Grow Rich. Yes, that's it. I couldn't remember. That's what it is. Okay. Everyone reads. And people think, Think and Grow Rich. Oh, it's just a book about how to be rich. Another how to. Well, let your viewers know that this book was written during the Great Depression, and these people who had nothing, okay, turned, into they molded the United States of America, and they're great people. And Napoleon Hill interviewed back then. This was mainly by Andrew Carnegie,
Right.
okay? But they interviewed Rockefeller, all of the people of that time, and you're going to see their thoughts. And that's the book, because it's smaller and easier to read. But yes.
Yeah, definitely a great book, and just all about how to, live a rich life.
Yes.
Not monetary wise, just all around,
Yep.
Yeah, definitely a great book. So lastly I had here was, what are your thoughts on, now you have people who swear by index funds. You could do index fund investing, buy mutual funds, pick your own individual stocks. What do you think is best? Do you prefer to stick to one or use a combination, and why?
Okay. Yes. Again, depending on the individual and their resources and everything else we discussed, I would generally, and I pretty much do, recommend all three. Okay. The index, the major differences are a stock market index, the S&P 500, the Dow Jones, or the stock market itself, the NASDAQ stock market. They are an unmanaged group of stocks. There's no one telling the S&P 500, oh, we need to get rid of this stock and replace it with that stock.
Mm-hmm.
Totally unmanaged. Okay. It's picked by Standard & Poor's every year. They select, they usually drop 3 and add 3 new stocks that meet their criteria or that don't meet their criteria. Okay?
Right.
So that's the index. It's unmanaged. The main goal of any investment professional, one of the main goals, is you always want to outperform the stock market. We want to outperform the S&P 500. Why? Because the S&P 500, as I just said, is unmanaged. No one is making decisions on it. The valuation of those companies goes up and down with no one saying buy it and get rid of it and replace it, except for that one time a year. So you want, as a portfolio manager and as a mutual fund investment manager, an investment professional, we want to do better than an unmanaged, because why? We are making decisions to a portfolio. We are saying, okay, we bought this stock at this price, we made our profit, let's get out and replace it with this stock. Or this stock didn't perform as well as we thought it would, time to replace. So we're actively managing a portfolio, okay? So we want to try and do better than the stock market. And then you do that 2 ways. The mutual fund manager is doing the same thing. So when you invest in a specific mutual fund, you hope that it does better than the stock market. The index is the stock market. And you own individual stocks, again, that's another personal preference. Again, you want to do better than the stock market. You want to hand select a few stocks that you like, okay, for many different reasons. Not that you like for many, but you want to own them for many different reasons. Number one reason is you want to make money. Everyone, that's why we invest. We want to make money. We want to have a great return on our investment. Mm-hmm. But there's a great satisfaction to owning individual stocks. And remember, the one thing that gets lost in the shuffle is when you own a stock, you are an actual owner of that company.
Right.
You can't tell the company how to operate, but you are an owner of that company, and you get to share in its profits. Right. You get to share in its success, and there's a great satisfaction to that. But other than that, owning the individual stocks on your own is the most riskiest, okay? But it's also the most rewarding. Mm-hmm. And, let's look at Tesla, Apple stock. Let's look at Google, where a small investment just, you made 1,000% return on it as compared to, investing in a mutual fund or investing in the index where you got your,
standard
10% return or 5% return or a 20% loss, whatever it is. So it risk reward, right? You're taking on greater risk you expect a greater reward.
Right.
But you take on the greater risk, you can also lose your shirt.
Mm-hmm.
So it's the risk reward. Again, so do I generally recommend all three? I recommend whatever's best for a specific, for a particular client, for a particular person. And I would have no problem recommending all three if that's what was suitable for that specific person.
Mm-hmm.
Okay.
You brought up Tesla. I discovered them a couple of years ago, and I got very lucky. That was when I, really was just getting serious about investing.
Right.
I put more in than I should have, but I was, I told all my friends, I said, you guys got to buy this. And
Right.
some of them did, and the ones that did not are kicking the air right now. But well, thank you for taking the time to come talk to me today. We'll definitely would love to do it again in the future.
Sure. It would be my pleasure. It would be my pleasure, Vincent. I appreciate it.
And do you, is there any way, do you want to leave like your website or any way for people to get in touch with you if they want to find out more?
If you can post it, you can, my website, it's a long website address. It's the name of my company, quantumadvisor.com. I can email you this information if you can post it somewhere.
Okay, yeah, I'll post a link in the description below.
That'll be great. It's the best way to get in touch with me. Email is preferable. Is probably the better way to communicate with me. But either way, I'm on Facebook, I'm on Twitter, I'm on LinkedIn, and I have my own website. Like I said, I have a great newsletter subscription service that I provide free to my clients. I love doing it. Like I said, when I first started with your interview, I love teaching people. I love educating people when it comes to financial aspects and money and helping them succeed and live a good life, and a good life has a different meaning for many people, but we all want to live a good, comfortable life. We want to, we don't want to worry about where the next dollar is coming from. We have so many different goals in life. Someone like me, my goal is to provide for my family and to make sure that they're taken care of. And so, we all have different goals, and it feels good to help people.
Yeah.
It's one of the reasons I got into this business.
Yeah, I agree entirely. And that's, that's kind of why I started the channel. I want to, spread the knowledge, what I've learned, and it's a continuous learning process for me, and, spread the wealth.
Good. You're doing a great thing. And again, thank you. Keep it up. Keep it up. We'll talk soon.
Sounds good. All right. Thank you. Take care.
Bye-bye.